Well, AT&T called. They want their dividend back. Yes, after being a dividend aristocrat, AT&T announced today as part of their offloading of WarnerMedia that they're cutting their dividend for the first time in over 25 years. And we'll get to that. If you're a shareholder, what does this mean for your dividend? What does this mean for future dividends of this particular stock? We're going to break it all down today in this video. Very interesting news. It's May 17th, and this news was kind of expected, but at the same time is not good for the dividend piece. Not good at all. AT&T currently owns WarnerMedia. What is WarnerMedia? Well, they basically became formed by the original acquisition of Time Warner by AT&T in October 2016. They acquired them for $85 billion, thereby forming WarnerMedia. WarnerMedia is made up of things like HBO, Warner Brothers Studios, CNN, Cartoon Network, and so much more. But why would AT&T be offloading WarnerMedia? Well, it's a very good point, and it's actually a trend that's going on right now in the industry. In fact, earlier this month, guess who offloaded a company? Verizon. Yes, that's right. The competitor of AT&T, Verizon Wireless, recently offloaded their Verizon media assets. That included things like AOL and Yahoo. AOL, America Online. Do you guys remember that? I would understand why they wanted to offload that. But anyway, so with Verizon offloading that for a grand total of $5 billion, they were able to take that money and thereby reinvest it into their own business and pay down their debt obligations. Kind of a smart move from that perspective so they can focus on what truly makes them the money and truly helps them expand their business. Now, I think the most important thing to start with is right here on AT&T's website. If you are a current shareholder, I do want to let you know of something that I read here. So of course, under the terms of the new agreement, which is structured as an all-stock reverse Morris trust transaction, AT&T would receive $43 billion, subject to an adjustment, in a combination of cash, debt securities, and WarnerMedia's retention of certain debt. Now, keep that in mind. We were talking Verizon Wireless at $5 billion. They're getting about $43 billion in this move. So kind of an interesting thing and something to keep in mind for when we go into their financial statement. But most importantly is look at this. AT&T shareholders will receive stock representing 71% of the new company. So once this all goes through and once this all gets figured out, if you are an AT&T shareholder like myself, you're going to see what's going on. You're going to get a little bit more of this new company. So I wanted to start with that. I think that's important. I will link this particular news release down below in the description if you want to check it out directly from AT&T. But let's hop over here. I want to break down why exactly would they decide to offload WarnerMedia. And then furthermore, what does this mean for your dividend? So we're going to break this all down, but look at this stock performance graph right here. So here we are on the stock performance graph. Look at this. Okay, so right here, this represents AT&T, the blue line, and then you got the S&P 500 index trend line, as well as the overall communication services index. Look what happens here. It's now 2016. I think this is an important thing to start with. Here we have AT&T up over not only the S&P 500, but most importantly right here, as I continue to just make too many red marks here on the iPad screen. But regardless of that, look at that above the trend in the communication services, but look what happens over time. In fact, I'm going to, let me choose a new color here. I'm going to go blue here. Look what happens over time. We start going down and down and up and down. But the most important thing to think about is look at their industry. Look at the S&P. Ever since that acquisition, my friend, look what happens here. We're going below the overall trend line. You want your company to meet, if not exceed, what's going on in the overall industry. Look at this, what's going on here. So what I would expect them to do is maintain above at least, if not the S&P 500, at least the communication services index. Even if they come down here right in the middle, I want my stock, I want my company to outperform its own industry. But if you're taking on a lot of random other things, does your focus kind of go off of the game? And thereby, you're starting to drip down, especially here in 2020, well below the overall index. And remember, guys, remember that in 2020 with the pandemic, a lot of people were staying at home. And because they're staying at home, what do they got to rely on? Telecommunications. And there was a lot of telecommunication companies that soared and skyrocketed. Why are we seeing such a dip down on AT&T? Well, if you have a bunch of junk in your trunk, that is what potentially could happen. So I think that's a very important thing to take note of. Another good point to look at is right here on their operating revenue statement. Look at this. We got $44 billion But look at what's coming from communication right here, $27 billion of the $44 billion earned. As far as WarnerMedia is concerned, you can see they contributed about $8.7 billion. So the overall aspect of AT&T at the moment is heavily still relied on by communication. So if you got that going on, you may want to, let's focus on what we can continue to improve upon. And that brings me to T-Mobile. Here we are looking at potentially what is an undervalued stock, but look at the current trading price of T-Mobile, $140. And look at the 1-year chart, up 49.11%. Compare that to 5 years. Look at that, 248% up. Do you see that on T-Mobile? Let's compare that to AT&T here. The 1-year chart shows us at 12.81 compared to down 17.65 on the 5-year chart. So here we have T-Mobile, guys. We're talking about T-Mobile outperforming AT&T. Let's look at Verizon Communications for a second. At the same token, you have Verizon sitting over here at $57.94, up 6.88%, up 15% on the 5-year chart. These are, right now, T-Mobile, from an overall perspective of communication, because their eye is specifically on the game, they don't have a lot of different other acquisitions in entertainment and communication. They're primarily only focused on their communication sector, and therefore they're kind of outperforming Verizon and AT&T in the financial market, in the investment market. And that's something that I think we need to keep in mind. Now, even though WarnerMedia did provide a little bit of extra cash flow to the AT&T statement, it also came with a lot of debt. Not only retained debt from WarnerMedia, but the fact that they had to pay over $85 billion in order to acquire Time Warner. So that is something that kind of carried on when it came down to AT&T. And take a look at this. If you look at this particular balance sheet in 2020, here we have $153 billion of long-term debt. Compare that to the year prior at $151 billion. But the most important thing that I look at when I look at long-term debt is that takes away from your overall free operating cash flow, especially as those debts come due. Keep this in mind. As we go through this new acquisition merger or deal, they're going to get up to $45 billion. Now, that's not going to take care of all $153 billion in debt, but what that does is that drastically reduces their overall debt, as long as they're not doing something absolutely absurd. So if you're managing your debt profile good, that will give you potentially more free operating cash flow. Then at that point, you can make the decision, do we continue to increase our dividends once again? Do we give a little bit more to our shareholders as we did in the past? The problem is if you're cutting it, you're then breaking away from the dividend aristocrat theory. And by the way, a dividend aristocrat is one that is part of the S&P 500 that has increased its dividend payout over the last 25 years plus. AT&T was, up until kind of today, a dividend aristocrat. But the fact that you're cutting your dividend, you now take yourself off of that list, which is kind of sad. I always enjoyed AT&T for the purpose of what was a nice, solid, increasing dividend. But let's keep in mind the fact that a lot of people also buy AT&T because they're interested in the dividend. What does this mean for the stock price? Right now, as I showed you, you have Verizon and T-Mobile outperforming what is a $31 price point on AT&T. Let's look at the one-day chart. It has started out with an exciting 33.63, and right now it's sitting at 31.34. It's going down. So my worry is people are going to hear about the dividend cut news. They're going to say, wait a minute, I bought into AT&T because I enjoyed those fixed income dividend opportunities. And remember, they're not cutting down to zero. They're still going to pay a dividend. It's just not going to be as much as you may be used to. So some people might say, you know what, not worth it. I'm going to move on to something else and sell out. And the more people that sell out, of course, that's going to drive that price down. So I think what we need to keep our eye on is what is this going to do for the AT&T stock? Until they find a way to rebound a little bit, showcase that, hey, our eye is focused on the goal again and not just trying to acquire a bunch of businesses. By the way, there's a lot of media saying, hey, the reason that you're selling WarnerMedia is because you're admitting failure at this point. AT&T is saying, hey, we screwed up and we're admitting that we're screwing up because we're offloading this business. Okay. Maybe I'll give you a half of a free pass. It all depends what happens next. Are you going to focus on your telecommunications business? Are you going back to the grindstone to really rise that up? If you can get yourself up to the valuation of T-Mobile, which currently is kicking AT&T's butt, as well as Verizon's butt in overall valuation, this could be an interesting thing. and an interesting opportunity for long-term growth in AT&T. That brings me to this right here. AT&T plans dividend cut from $43 billion Discovery Media merger. So they're going to, obviously, as I mentioned, they're exiting the list of dividend aristocrats amid plans to lower its payout as much as $7 billion in the wake of media asset merger with Discovery. So that's something that, as an investor, you should be keeping your eye on. You should always look at these type of things to understand, is it worth holding on? Is it worth selling? Never sell for a loss. If you were only in it for dividends, is this the way to go anymore? I don't know. AT&T said its dividend payout ratio, which was around 63% in the previous quarter, will be resized to account for the distribution of WarnerMedia assets into a new company. The remaining AT&T assets will aim to give shareholders a dividend payout ratio of 40 to 43%. That's a cut of 20% of the dividend payout ratio. So we're going from 63 to 43, something to keep an eye on. The company said based on anticipated free cash flow of around $20 billion. And if you look down below here, Jim Cramer even said it himself, just very similar to what I was just saying. Even though the Discovery is going to be great, the merger, that's not where people owned AT&T stock. So you have this issue where the AT&T shareholder gets the equivalent of a good dividend, because if you're targeting a payout ratio of 40 to 43%, you're dividend cutting from $15 billion to $8 billion. And again, it goes back to the concern, are we going to see a little bit of a sell-off, thereby that price drips back down below $30, could be well in its 20s once again as a result of people exiting that strategy. We'll have to see. Jim Cramer even took to Twitter saying things like, glad tea is up, good chance to lighten up if you want income. Of course, people must have listened to him because, as I showed you earlier right here on the chart, as we went through today, that did go down quite a bit. Starting at around 33.62 for the day and ending all the way down at 31.37. So it did lose some of its momentum. Not saying that Jim Cramer is at fault by that, but I think a lot of people were making the same type of thought process when it comes up to what should I do with AT&T? So we'll have to see. I think if AT&T is very strategic with their broadband and telecommunication services, they can take that, continue to increase their overall free cash flow as a result of having less debt from these prior acquisitions. Now, of course, what we're going to probably end up seeing in the interim is a lot of people that are income investors sell off in order to find a different stock or a different ETF that pays a better dividend or has a little bit more stable value. So we could see a little bit of a sell-off, but I think if they do the right thing, less debt equals more free cash flow equals a potential for a higher stock price in the future. Could this be a buying opportunity? We'll just have to see. What are your thoughts on AT&T? What are your thoughts on this news? Is this going to be good or bad? Drop a comment down below, let me know. Until next time, here's some other videos that you might find helpful. And until next time, we'll see you on the next video.